Hey everyone, welcome to The Explainer. I am absolutely thrilled you're here today because we're conducting a comprehensive financial physical on a genuinely fascinating company, Watts Water Technologies, trading under the ticker WTS. We're going to dig deep into the data, strip away all that everyday market noise, and look purely at what the fundamental numbers are actually telling us. So if you love structured, direct analysis, you are exactly in the right place. Let's get into it.
Just look at this number for a second. Over 1,000%. That is literally the 20-year total return for Watts Water Technologies. It's a massive figure, right? And it proves exactly why this company demands our attention today. I mean, finding businesses that can compound wealth at this kind of magnitude over 2 decades is super rare. It immediately raises a vital question. How exactly did they do it? And what does the data say about where they stand right now?
To answer that, here is our roadmap for today's explainer. First, long-term stock performance. Second, revenue and profitability metrics. Third, the dividend growth story. And fourth, valuation and margin of safety.
All right, let's dive right into Section 1, long-term stock performance.
Okay, so if you were just casually glancing at the short-term metrics, you might actually be a little underwhelmed. The last 7 days show a slight dip of negative 1.08%, and the return for 2024 is sitting at negative 1.62%. But hey, investing is a marathon, not a sprint. Check out the longer-term view. The 10-year return is a staggering 482.50%. And of course, that 20-year return tops 1,000%. This brilliantly illustrates why patience and a long-term perspective are absolute virtues when you're evaluating a compounder like this. The day-to-day volatility completely masks a powerful decades-long upward trajectory. And here's what's crazy. This upward trajectory, it's not just consistent, it's actually accelerating. The compound annual growth rate, or CAGR, for total returns over the last 5 years was nearly 20% annually. Over the last 3 years, that's sped up to 23.17%. And trailing 12 months, a massive 55.03%. The momentum here is absolutely undeniable. But as focused learners, we know stock charts only ever tell half the story, right? We really need to see the underlying business mechanics.
Which brings us to Section 2, revenue and profitability metrics.
First things first, let's talk about scale. Watts Water Technologies is not some small mom-and-pop operation. They brought in $2.438 billion in trailing 12-month revenue. That's huge. But it's not just a stagnant pool of money either. Their 5-year revenue compound annual growth rate is a very steady 10.08%. They are consistently expanding their top line by double digits year over year.
However, you know as well as I do, top-line growth means absolutely nothing if a company can't convert it into actual profit. Well, Watts does exactly that. Their net income CAGR over 3 years is 10.65%, jumping to 16.99% for the trailing 12 months and an incredibly robust 24.41% annualized over the last 5 years. They aren't just growing sales, they're actually growing their bottom-line profits even faster. And that, my friends, is the ultimate engine for stock price appreciation.
So how are they pulling this off? It really all comes down to margins. The gross profit margin sits at an impressive 48.32%. Basically, for every dollar of revenue that comes in the door, they keep nearly 50 cents before operating expenses. This points to some excellent pricing power and cost control at the manufacturing level. Then, after all expenses and taxes, which run at an average of about 23.55%, they still pull down a net profit margin of 13.48%. This is the sign of a highly stable, operationally efficient business model.
And if we wanted to summarize all of that operational efficiency into one single master metric, it's this right here, 18.37%. That is their return on invested capital, or ROIC. Anything consistently in the double digits is fantastic, sure, but pushing up toward 20%, that means management is incredibly effective at taking capital, reinvesting it back into the business, and generating high-yield returns. It is literally the hallmark of a high-quality enterprise.
Okay, let's switch gears a bit for Section 3, the dividend growth story. If you're a long-term investor looking for income, there is really only one critical question you have to ask right off the bat. Is the dividend actually safe? I mean, could this income stream survive an unexpected economic shock or a severe market downturn? Let's let the data answer that for us.
Now, at first glance, the dividend yield might seem kind of underwhelming at just 0.70%. But hang on, notice those 13 consecutive years of dividend increases? And we aren't talking about tiny little bumps either. The 3-year compound annual growth rate for the dividend is a massive 20.12%. But here's the best part and why it's incredibly secure. They are paying out this rapidly growing dividend using only 19.47% of their free cash flow. That leaves over 80% of their cash completely untouched for reinvestment or, a rainy day. Add in a near-zero debt-to-equity ratio of just 0.10, and you've got a rock-solid balance sheet. So is it safe? The numbers scream yes for sure, with massive room for future growth.
Which brings us to our final and arguably most interesting part, Section 4, Valuation and Margin of Safety.
If we just impartially look at the traditional valuation multiples, honestly, the stock appears quite expensive compared to its own recent history. The price-to-earnings ratio is currently 29.23, which is almost 11% higher than its 3-year average. Price to sales is at 3.96, running almost 13% hot, and price to book is at 4.89, nearly 8% above average. Traditionally speaking, these metrics alone signal a premium price stock. It basically suggests the broader market fully recognizes the quality of the business we just spent all this time analyzing.
Before we jump to any major conclusions from just those basic multiples, we really need to understand the concept of a margin of safety. Basically, it's the difference between a stock's intrinsic fair value, what the underlying cash flows are actually worth, and its current market price out in the stock market. Finding a large margin of safety is absolutely crucial because it provides a buffer for any investing errors or unforeseen headwinds down the line.
So let's apply this to Watts Water Technologies. When we juxtapose the market reality directly against the fundamental data, a really massive gap suddenly appears. The last close price was $297.28. However, based on the discounted free cash flow models from our source data, the calculated fair value price is actually $513.05. There's just a massive disconnect between what the market is currently charging for the stock and what the mathematical free cash flow models dictate it is fundamentally worth.
And that gap? It translates to a whopping 42.06% margin of safety. Yeah, you heard that right. That means the stock is trading at roughly a 42% discount to its mathematically calculated free cash flow fair value. So even though the traditional PE multiples look pretty stretched compared to historical averages, the sheer volume of free cash flow being generated here, over $356 million in the trailing 12 months alone, paints a picture of a seriously undervalued asset based on its intrinsic cash-generating power.
And that brings us to the ultimate tension in the data, and the final thought I want to leave you with today. We have a highly efficient, rapidly growing, cash-printing business with near-zero debt, yet it's sitting right at this weird crossroads of valuation. So I pose this question to you. Does a massive 42% discount to intrinsic fair value justify buying a stock that is currently trading at historically premium PE ratios? The fundamentals are incredibly strong. The margin of safety is super wide, but those multiples are definitely hot. What do you think the right move is? Thank you so much for joining me for this explainer. Keep analyzing, keep learning, and I'll catch you next time.